There are 8 key market signals that every trader and investor needs to be across to avoid being destroyed in the next market cycle. This is coming from Gary Glover, an investor and advisor for over 20 years, and he's got a solid track record that is on this channel. Now, we're going to look at these 8 key signals, understand them, and also see how they're going to impact both our trading portfolio and our longer-term portfolio that we all hold. Plus, we're going to look at 5 ASX companies that Gary's looking to add into client portfolios in this market. Gary, it's a lot to tackle, and we'll probably just jump straight in to look at the one that's glaring us in the face. The valuations. This is something we've talked about for a while. It seems to be only one of the 8, but how does it stand up in what you're looking at?
Yeah. I mean, it's a fascinating time here right now, Chris. Sort of done done a lot of work here in the market the last couple of weeks, just looking at, looking at a lot of the intangibles and intangibles in the market there, and just even looking at some of the deeper sort of cycles that run through the market as well. So, probably not going to exaggerate here. This might be the most important report I've written for the year, in terms of where we sort of sit, from a market perspective. You're quite rightly, we've got, extreme valuations there. So we've got, our stocks are trading on big multiples, across the board here. So whether you're a, top 50 stock, with flat to single digit or flat earnings there, you're trading on 20, 30 times earnings here. We've got high growth sort of companies that are trading on 100 to 150, 200 times earnings as well. So, but we've got those excess valuations, those extreme valuations, which just one ingredient there. But we do know that, stocks, from momentum sort of studies, we know that stocks are expensive and high PEs, they can keep going. So that's only sort of one sort of thing that, to be kind of wary of there. Also, has the market moved through all the gears? That's always an important, ingredient for me. And what I mean by that is that when a bull market takes off, it starts off with the big caps and it filters, down the line, sort of through to mid caps. And then when you're at the end of the, bull market, it's normally the small caps do the, kind of come in late to the party here. So we've seen probably one of the best small cap markets we've seen here in the last month or two. So they're usually the last component to, in the last stage of the bull phase. So we've got another tick there. The other thing you sort of see there from an intangible point of view is complacency sort of set in. So, when we've been going up for almost 6 months there with only a few days down, and so there's lots of stocks and sectors that people just don't think they're going to come back here. So, so I think there's a level of complacency, and I think the AI is kind of hiding that as well. And it's almost like the tech boom when that was sort of going, it was sort of running. It got to the point there, everyone just got complacent. They just sort of thought we'll just keep running forever there. But, so it does feel like there's a level of complacency there at the moment there. Everyone sort of keep ready to, roll into the next sort of name here. So those are probably some of the intangibles there. The key things that probably more tangible there is that we see, at all market tops is we see that market breadth deteriorating. So, and we've seen here that if you look at the S&P 500, in July, around 80% of the S&P 500 was trading above the 50-day moving average. Now, as momentum traders there, we know we want to be above the 50. If we start sort of breaking down to 50, that's a sign of weakness there. That's sort of usually stocks breaking down here. So before last week, that 80% had to sort of deteriorated from July sort of all the way through to early October here. Only about 55% of the companies were trading above the 50-day moving average. So, 45% of the S&P 500 has been breaking down as trading below the 50 and showing real weakness. And that was before Friday, Chris. So the reading after Friday would have been a lot lower. Might have been only 40% or maybe even less. So it does sort of show you there that the underbelly of the market is losing momentum and getting weak. And you say, how does that happen? When the indexes keep climbing and going to new highs, where you've got half the market actually breaking down here. How that happens is that the leaders, this is the fifth point here, the leaders do all the heavy lifting at the end. So those sort of strongest names there. So whether it's the Mag 7, In this case, it's the Mo 7, the momentum 7. So stocks that are like Palantir, NVIDIA, all in that sort of AI sort of chip space, they're sort of the stocks that got the strongest momentum there. So they were all last week, all trading as a group around 20% above the 50-day moving average. So they're extended. They're pretty extreme there. So if you look at our market, like Drone Shield is around 40% away from the 15 moving average. I think 360 is about 15, 20% away. So some of those, even our leading names, are trading still at pretty extremes there. So that's what happens at the end of the bull phase, is that the majority of the market starts breaking down, and the leaders do the heavy lifting at the end. And so again, we've got tick there, sort of 4 and 5 here. If we look at a technical perspective, so look from a probably an advanced sort of technical perspective, we get kind of squaring. Like, it's important to sort of see sort of squaring. So we sort of showed S&P 500 there previously. That I think it was the GFC. That's kind of squared out, and every high, every sort of 100%, 200% squaring there has sort of, if you hit resistance at those points there, you normally sort of pull back, and they don't get exceeded for at least 6 months. Sometimes they can be 12 months or 18 months, but we know that once they hit resistance at those key squarings, the market sort of will normally stay under that level for 6 months there. So we've seen here on the S&P that it's squared out from the last pullback to the 150% level. It's also a big squaring on that O2, on that GSC sort of squaring as well. And then like the NASDAQ has also sort of squared out as well. So interesting there, that 225. So the NASDAQ had its big correction in 2002. So that was the tech boom. So all the tech wrecks, that was probably one of the biggest bear markets for the NASDAQ. So if we square that range, 110% sort of moving forward here, that's marked a lot of highs here. So we do have another short-term squaring 150 from the last pullback. And we've got like a massive squaring there, 550, coming off the 225 low. So just perfect harmony here for a nice top here at the moment. So that's probably the sixth thing there, which is a little bit more advanced, but definitely sort of, markets tend to sort of move in increments there. The seventh thing is that all highs, and I've shown this, quite a few times in the last few years, that all highs will end with with either a 1 quarter or a half year cycle, Chris. So that it'll either go like a quarter year from low to high, or it can do sort of like a half year from the previous high to the previous high. Sometimes bit rarer, but it does happen. You do get a half year cycle from low to high to finish the move. It's not the most common because you don't get moves this strong very often, but we know that that's important timing here. So this sort of 26-week cycle, there's definitely heaps of validity there from that cycle. So we had lots of touches on there. So came in like a day or two late here, but that's okay. We know from cycles there, if we allow ourselves an extra 1 or 2 days, that's still pretty valid there. So we've got pretty good timing here. Good technical levels there as well. So that's kind of number 7 there. The last thing we see, and this is a William O'Neill sort of, is that we see distribution days, a cluster. So we normally see 4 or 5 distribution days within a few weeks. So what distribution days are? If you're down by, say, more than 0.2 and the volume is heavier than the prior day, that's a distribution day. So, but right now we've got 3 distribution days on the S&P 500. We've got 4 on the Dow and 4 on the NASDAQ. So normally once we see 5 across majority of the index, 2 out of 3, then that's normally sort of a sign that you're actually going to sort of build. And that's probably the last thing we see is those sort of selling a bit heavier on the down days. So we're pretty close here. That's why I sort of think, all the, if we go back and look at history, all the things we normally sort of see, we're ticking all the boxes here at the moment. We're seeing all the things we normally would see at classic highs here. So I know this market's got some great momentum there. I know there's sort of AI is driving a frenzy there, but was interesting as sort of, did we need a catalyst to mark the market down, or was the market just ready for a catalyst? So, I'm a big believer when time's up, time's up. So, just a little pretty cautious here at the moment that the time could be up for this bull market here. So just going to be, if I was long a few stocks here, I'd be sort of tightening up, be trimming, little bit of hedging. I've sort of scaled right back. I've increased my shorts substantially here. So, I think there's just a lot of, just all the signs there of a classic sort of peak here. So, so the big thing for me is are we going to just pull back a modest amount, or are we going to pull back something a little bit harder? That's the thing I'm not so sure about here, because next year's our midterm year, and that's typically, if you look at our 4-year sort of presidential cycle, that's usually our weakest year. The strongest sort of 13 months comes out of that October midterm year, which is next year. 6 years in particular have a pretty weak first half, so we know the market's going to be under pressure probably for the first half of next year. So, are we going to get a topping pattern here first? Are we going to get something a little bit more severe? I don't know, but all I know is that we're seeing some signs here to be that are quite bearish to me, and telling us just to be need to be on our toes here, and risk is pretty high.
So there are 8 key factors that a lot of us would look at and possibly study 1 or 2 at the same time. For you to see them overlapping, that's what's got you going, well, hang on a second, I am going to lean into my bearish positions. I'm going to understand my cycles. For those who aren't sure and are new to cycles, this was something that was new to me and took me a long time to get across. We'll put a link there on if you want to look into that in more detail, because it's really quite fascinating, and there's a huge amount of history in this channel that you can walk through for Gary's reports. What I'm interested in now is, Gary, we know that you're also a momentum trader. So we know that you trade the top right. We know that you'd lean into the best and the leaders. You've studied them extensively. So there are opportunities that you can trade with clients in this cycle. And being in Australia, we do have the benefit of a different composition within our market. The S&P 500 has a lot of industrials and technology companies. In the NASDAQ, we don't have a lot of that, but we have heaps of miners. And we can run out of sync and still trade as the index falls. So it's an odd anomaly that we have, so let's take advantage of it. In your report, you've got one of the gold miners there, Evolution. Can you explain to us what's happening here? Because this is super extended, and how you look at this when the market's falling, there's something roaring ahead, but you might not necessarily actually trade it. So what are you putting this in the report to teach us this week?
Yeah, I mean, just I know a lot of people think that gold is a hedge. So if you think the market's going to heal off, then we'll buy some gold and stuff there. But from my experience, the gold has often tracked equities pretty closely, and I've made this mistake in the past, thinking that gold would be a hedge, and even the gold price might actually even sort of stay firm or not deteriorate. But the market deteriorates, find that the gold stocks will get dragged down with the market. So that's just an observation in the past there. But if we do look at the gold stocks there, I mean, they've had a pretty decent bull run here, Chris. I learned this from the late Bill McLaren there, talk about vertical trends, or what he would call a blow-off trend. So on a weekly chart, once we sort of get 3 ascending trend lines, so you're basically sort of building a base, then you sort of start to accelerate, and then you're accelerating again. Now, those sort of accelerating trend lines, they can go 4 or 5 accelerating trend lines here. But once we break, this last move here is getting pretty vertical here. So once we sort of break below that trend line, Chris, there's every chance we'll come back to where the last low sort of started, last acceleration point. And if that's if that's done here, it'll often actually come back to where the third trend line begun here, which is around that $5 mark here. So everyone's going to think I'm crazy here, thinking that this can come back to $7 or even $5. But if we study vertical trends in the past and blow off moves, I'm yet to find one that hasn't come back to at least the last acceleration point. But I'd say 89% of the time it'll come back even deeper, back to the third here. So just one of those things here. So look, it might keep running here. Gold's still pretty firm at the moment, but we are pretty late here. And if the market does start to deteriorate there, don't fall in the trap of thinking that gold's going to save you, because I'm not sure it will. History says it probably doesn't. The only reason to be long here at the moment is it's the inflation trade. So we know sort of high inflationary periods of the past, we've seen energy and precious metals be pretty strong. So that's one of the reasons why it's strong here. But it's had usually a pretty strong correlation to conflict risk as well. So if we see a Middle East sort of peace deal here, that's one less conflict. That's normally sort of the conflict tends to sort of drive gold higher. So that's really it for evolution there. The other
Which just on that, I would actually say I've been skeptical of these sort of pullbacks as well. And this is something you put your head out there, put your hand up a while ago when Drone Shield did its last rally and then pulled back heavily. You have made an early call and said, look, it probably come back to a certain level. That's another video worth checking out to see and understand how these leaders have pulled back in times gone by. So that's interesting. But National Australia Bank,
usually I get hate mail too, normally, Chris, as well. So yeah, which normally will be, if I do get hate mail, then that confirms that'll actually probably be a strengthener for me in terms of what's likely to happen. So there's a lot of people fall in love with these stocks because they're running so hot, and then you sort of say they're going to have a big correction, they go out and make it.
get rocks in your head.
No idea. I get you get no idea, and then
You're not a believer. You need to understand. You need to understand this thing is going to $500. And
once I start getting that, then I sort of start. Oh, I can get I probably should start shorting this.
it's the defying gravity in many different ways. So National Australia Bank, we've talked about the valuations. We understand that CommBank is excessively valued in the sense that it's the most expensive bank in the world. It has come off a little bit since grabbing that title. ANZ's been on a roar. National Australia Bank has moved actually since you created this chart. You do create these charts on weekends, send them to clients, and then we dissect it on Tuesdays. Here we are. What is it about National Australia Bank that we need to be mindful of?
Yeah, I mean, I just like the one thing we often see with bull markets is, and we're seeing a lot of this too, actually, is that around that sort of squaring of the ranges, one thing we can sort of see, and we often see it actually with the XJO, is that oftentimes the last leg in the bull market, so a bull market might go for, say, 3 or 4 years. The last leg up, the last 6 months of that sort of 3 or 4 year bull market can be like 50% of the entire range. It's been built for 4 years. And sometimes it can be even more. It can actually be around the 61.8 as well. So even broader here, the last leg up. So if we see the last leg up in the bull market sort of square out over the 50% or the 61.8, that's a bit of a, something we see quite a bit at major tops. We see it quite a bit on the XJO. So we're seeing it actually in a lot of stocks at the moment here. Seeing a lot of stocks sort of square out from either the 50% range or and that's just something we sort of see over and over again. So we're seeing that here with NAB. I think sort of since posted this chart here, the stock's actually broken down quite a bit. So quite negative there. I think ANZ's sort of pretty similar. It has popped a little higher here. So I might need to go and look at another squaring there. But we do have like a nice little fourth wave and a fifth wave here. So as we speak, I think we've sort of hit the 15-year high or so on the stock here. So yeah, I think new CEO is going to bring in more bankers and get
Decrease
commercial here. Also, yeah,
chase the margins at CommBank stocks, market leader.
Yeah, so as we speak, I've literally covered my NAB short and I've put on an ANZ short here. So yeah, but it's I think this, we're seeing here with the banks that they're trading on excessive valuation. So we saw CVA peel back. Now we're seeing sort of NAB peel back here. I think ANZ is crazy at $36 there. So that's going to be a good short in my opinion. So
to learn from history, there's another part of the market to look at, which is healthcare. You've got Ramsey in this week's report. So we're flipping the charts. We're going from those at the top, excessively valued, market leaders, very, very high. Ramsey sort of trawling out a bit of the bottom. So if you're mindful that the market may come off a fair bit, you've just walked us through those 8 indicators that we should really be mindful of. Why is it that you'd be buying something or looking at adding something down at the bottom? How does this work and fit into that narrative?
Yeah, so normally when you're sort of peaking, like in growth, then normally the defenses are often sort of finding a low at the same time. So it's weird to sort of think, markets at all-time highs, and then shouldn't everything sort of fall away in unison? That doesn't really, it's not always the case. So you definitely see other sectors um, go up there. And and the main reason that happens is that you sort of, the money's got to go somewhere, Chris. So it comes out of high risk, high growth sort of stocks, and then it starts to go sort of somewhere safer. So, you know, no surprise to sort of see that, some of the healthcare names, some of the staples, some of the defenses were actually up the other night when the market was getting belted. So, so that's what you normally sort of see. So I think healthcare, staples, and utilities there. So I had to look through all those areas there, and then probably the healthcare is the one that's probably had the largest correction there. Um, Woolworths is one that's had a fair pullback in the staples, but Metcash is pretty small. Coles are still pretty elevated, so not too many staples there jumping out at me. On the utilities there, again, some of them had a bit of a pullback, but nothing excessive there. So there's one or two opportunities there, but not too many. But really, healthcare is probably the one that's seems like the whole sector's had a fairly decent pullback here and come back pretty hard here. So just like what I'm seeing here on CSL, it's had a big pullback, had a bit of a washout there. The reason I like what I'm seeing here is that it's actually, although it's had a bit of a bounce and it's still in a pretty strong downtrend, on the recent down days, we've seen the volume dry up. So I'm just sort of starting to see those sort of, we're pulling back here on much lighter volume. Because look at that selling all the way down. It's been pretty heavy. The heavy volume all the way down here. That can be, you can exhaust into that, and then you'll have a bit of a bounce, and then you should pull back again. But if you start to see the selling dry up, that's the sort of first signs there. So what we're looking for here, we're probably going to be patient here, wait for a bit of a base, but these are sort of sectors that we want to be looking at there. So I know sort of CSL, Ramsey were probably the two that were sort of standing up to me. That Ramsey sort of come back and made a bit of a false break, retested the old low here. And again, this sort of elevated volume at the last low, elevated volume at this low here. If they can hold here, hold that low there, definitely want to sort of keep an eye on there. It's in a bit of a transition phase here, Ramsey too. You sort of had a new CEO in there for a little while, making a few changes there, probably a little bit more, acting in sync with what the market wants as well. So, as opposed to like the last sort of leadership group, they were probably just doing what they wanted. But yeah, so I think it's definitely one to sort of keep an eye on here. So yeah.
One that I was surprised to see you put in the market report, this week's report, in the context of what you're talking about with the market coming down and then opportunity. We wouldn't normally see travel as being consumer discretionary, possibly be a pick into this kind of movement, but for whatever the demographics are or the underlying values, I'd love to understand. But can you walk us through why you see these as being an opportunity? Is it because they're down at the bottom half and sort of when they find the lows, they're sort of out of sync? What's the drive?
Yeah. Yeah, no, you're spot on, Chris. It's not normally, you wouldn't normally be seeing travel stocks, down at the lows here when the cycle's like this. But I think that, the amount of extra conflict going on around the world here, obviously the Ukrainian Russia conflict, Middle East conflict, you've also got the potential there of sort of Europe coming into conflict with Russia as well. And we're seeing, all the defense stocks raging here and everyone's spending money on defense products. So not really great for travel companies, but we are sort of starting to sort of see them, show a bit of support there. So I saw Webjet break out of a little bit of a descending wedge there after a somewhat positive update. Retesting the old lows, sort of showing some support here. And, Flight Centre's been really congesting as well around that old low as well here. So, if we do, I think a lot of these conflicts have probably weighed against these stocks here. So if we do start to see some resolution in some of those contracts, some of those conflicts, then that's definitely a sector that could benefit there. So, not normally we wouldn't normally see them at this point in the cycle, but just I guess one of those things that's taking place at the moment here.
Well, there's some solid insights with those 8 key factors in the portfolio opportunities that you're seeing within the market. What we're going to do is put a whole whole playlist to the right-hand side, which is Gary Glover's insights and educational playlist, where he walks through these things like cycles, bold back technique, a whole sort of trading setups, and understanding how and when markets work. So click on that if you want more detail. And we say thank you very much, Gary Glover from Novus Capital.
Thanks, Chris. Yeah, look, just everyone take a bit of caution out there. Just just be a little careful here. I think might be time just to just trim a little bit personally. If you don't want to trim, just tighten up your stops there. But yeah, it's just a few warning signs sort of ringing for me. 20 years of sort of studying the cycles and the charts and markets there just tells me to be pretty careful here. So we've had an awesome rally. We've had we've had 6 months there without a pause here. So to have some sort of small pullback, would make a lot of sense here. To have something a bit bigger is a possibility as well. So just be aware of that.
That seems very reasonable indeed. Thank you.